Hi, Hunter Hastings here. Entrepreneurship requires funding. Because entrepreneurship is the creation of valued experiences for customers in the future, it requires a development period where revenues are less than costs, and therefore profit is negative for a period of time. It's often called the J-curve, where the J is the curve of the line below the zero profit line, which gradually ascends towards that line, eventually surpasses it, and then profit can fund the continuing cycle of value creation and value realization. Fortunately, we live in an institutional environment where there's funding for the J-curve, and the most usual form of that institutional funding that we think about is venture capital. Venture capitalists bet on entrepreneurs being able to drive the J-curve to profitability, and they'll fund that period. But it is an institution, and the nature of institutions is they don't have equal access. If you didn't have the right education, you don't have the right connections, you don't live in the right part of the world, maybe access to venture capital funding is more difficult for you. The other point about entrepreneurs is when they see an institutional problem like that, they act to solve it. And today's guest is one of those institutional innovators. His name is Brian Hollins. He's the founder and the managing partner of Collide Capital, a $66 million VC fund designed to solve the problem, to fund the most deserving rather than the most connected. Those who've lived experiences suggest that they have investable grit and investable courage, even if they don't have other credentials. He's also a founding member of BLCKVC, providing access, education, and community for Black investors. He founded the Takeoff Institute, which helps Black undergraduate students with business and network development. And even when he was inside the institution at Goldman Sachs, he was the leader of the Emerging Entrepreneurs group there. So Brian personifies the concept of institutional entrepreneurship.
This is the Value Creators Podcast. Value creation is the sole purpose of any business and every business, and for all of us as entrepreneurs. Listen to great value creators as they share their successes, trials, and lessons learned. Join us as we explore how to think as value creators, how to act as value creators, and how to view business through the lens of value creation.
Brian, welcome to the Value Creators Podcast.
Thanks for having me. Looking forward to this.
Well, we're excited. We're big supporters, obviously, of entrepreneurship here. That's what we think of as value creation. It's great for customers and end users because entrepreneurs are creating better products and services and better experiences. And it's great for entrepreneurs because there's meaning and purpose and a lot of fulfillment and hopefully income and wealth at the end as well, although those are contingent, obviously. But entrepreneurship requires investment. There's a period before takeoff where the costs are greater than the revenue. There might be no revenue, so you need investment. We've got an institutional setup for that, venture capital and other forms of investment. But one of the issues is not everybody is plugged into that institutional environment. Yeah. They can't all be part of the incubators at the universities and the VC pools and so on like that. And that's one of the things you're addressing. So let's start there. Tell us about that differential access and some of the things you're doing about it.
Sure. Thanks for having me. I'm a big fan of what you build here. And I'm happy to share my thoughts. Hopefully somebody finds one or two nuggets out of our time together. And if you're building anything, I'll start by saying this in case anyone leaves. Brian at collidecap.com. Feel free to shoot me a note. I'm happy to see if we can be helpful. I'll zoom backwards a little bit. I was lucky enough to go to Stanford for undergrad, so that's where I met innovation. The boys who built Snapchat were down the hall from me. The guys who built Instagram had just left the campus. And so I had sort of front row seats to some of the tools that are, not only around today, but are thriving today, 10 plus years later. And so I got a chance to meet those people that you're talking about that have that access. And I think through the process of meeting them, found two things. One, found that some of them were absolutely exceptional. And so the people that go to schools like that have some of the most audacious goals, and their ability to lean left when everyone else leans right is absolutely remarkable. And then two, learned that there's a bunch of people that are there that don't deserve to be there, and that don't deserve the resources that they get, and don't deserve the fifth strike and sixth strike that comes with having shiny logos on your LinkedIn. And so through my time supporting founders and entrepreneurs who didn't have that access, I said to myself, what are the ways that I can translate the learnings of someone who does have that access and make it palatable, digestible, sort of easily readable for someone who doesn't, in such a way that they can take advantage of it. I got together with a group of friends. We started an organization called BLCKVC. Today, it's the largest Black investor network in the world, helping people of color get into venture, up and through the ranks, into partner capacities. And so spent a ton of time in that role helping entrepreneurs of color learn the journey and learn how to get in front of Lightspeed or Benchmark or Sequoia or whatever it may be. And not only get in front of them, but learn what they're looking for. Start to understand what is required to raise $2 million in a pre-seed, or $6 million in a seed round, or $15 million in a Series A. So to your point, kind of learn what that motion looks like that so many of their companies run. And I fell in love with that art. I fell in love with that practice. I deeply enjoy coaching founders through what I would argue is a core competency of being a CEO and founder is fundraising. If you don't know how to fundraise, you better learn how to fundraise. But if you think, as you are coming out and starting a company, that you are not going to spend a majority of the next 10 years fundraising, I would beg to differ. And so I spend a lot of time really helping founders understand how to move fundraising away from this horrible big demon that they have to fight every time they run out of money, and instead approaching it as a piece of the job. And very similar to how a triathlete runs a race, understanding that there's multiple components to this race. One is building a customer base, the other is building an employee base, and the third is fundraising and building a capital base. And so looking at it more holistically as just a component of your business is something I really try to translate for these communities that typically haven't had access to that capital.
How do you get them started across that gap, Brian? So here I am, a disadvantaged entrepreneur, let's say, doesn't have that access, didn't grow up in the institutional environment. I can't even see Lightspeed or Coastal Ventures or any of those places. So how do I get started? How do I hear you? This is something I have to do. I need coaching. I'll take the coaching. Get me going. How do you do that? It's part educational, right? So it's part just, you don't know what to ask for. And so helping them understand, what does best in class look like? What are the top 20 firms in the world? What do companies who have tried to build in this industry look like? What is the path to, $100 million of revenue look like for a software business? Or maybe you're building a services business, or maybe you're building a fee for service business. So introducing business model and helping you understand the different ways in which you can go about selling a product. But the other component is just, I think, introducing curiosity. If you're not interested in learning how to get better at navigating that world, I can't really help you. The founders that I've had the most success helping are the ones who, it might take a little while to get them to believe that fundraising is a core competency. But once they agree with me, they are now willing and ready to run head first through the wall to figure out how to get better at it. And I think that coachability aspect is something that I've learned to hone in on, because oftentimes it's not that I'm so compelling that you are coachable for me. It's that you just understand coachability, and you are also coachable for your customers that tell you things that they want. And you're also coachable for your employees who tell you how the culture should change. And so I find that to just be a valuable skill set. And so I look for founders who are able to demonstrate some of that. We do something together, or we agree to do something together, and they come back 3 months later having not only done that thing, but done that thing exceptionally well, to the point where it compounded into some other effort that they were able to achieve. And so seeing that unlock is really valuable.
But I think education and that coachability aspect are two of the main things that in the early days, at least, we have to get through together in order for the 3 to 5 year journey to work.
One of the fears is that a lot of it is networking, and it's a
Yeah.
network I'm not plugged into. I don't have those connections. Is that a baseless fear? You can get into the network, or is there a skill there as well?
There's a skill there as well, but it's not a baseless fear. It's absolutely true. It's grounded. I mean, it's very unfair. And now it doesn't mean it's not, and it doesn't mean you can't overcome it. Exceptional founders who have built businesses never touching Sandhill Road. So let's also caveat to say you were talking about accessing venture capital. There are 50 different ways to raise money to successfully scale a business, or not raise money and scale a business. So I think sometimes also founders fail to acknowledge that there are different ways they could build a business. However, the way they want to build it, which is growing, exponentially and going from 5 employees to 500 and them ringing the bell at the NASDAQ, that's the shiny example. And that's why most founders want to do it. But there are a lot of different ways that you can scale a business. So I also want to leave that there.
Yeah.
But I do believe in order to understand how to tap into venture capital, you have to recognize that there are years of examples of what it looks like to do it well. And oftentimes those examples are loaded with the schools that you just talked about, or coming from the organizations that, have already been there, or, already sold a business and are going back for the second time. So there's pattern recognition that exists across Sandhill Road. And I'm using Sandhill Road as an anecdote for just the entire venture ecosystem. Yeah. I mean, let's use Andreessen, for example. A16Z has made a lot of money in their time. And so when you've taken a business from seed stage to IPO, you start to build cognitive bias around what success looks like, because that business was inherently successful. It paid for a lot of businesses that weren't successful that you got wrong. And so whatever the archetype of that pre-seed to IPO business is, you're going to look for more inherently. And that's what happens over time. And I think over the last 3 decades, Sandhill Road has afforded itself the ability to look for pattern recognition, which has then just made it hard for people who don't have that pattern recognition. And I think you didn't ask this, but I think there's a lot of ways to use the community of collaborative kind of ecosystem builders around you to help you in that journey. And I do that pretty religiously at Collide. We spend a lot of time helping founders who don't start on third base understand how to crack into those ecosystems.
Yeah. So on the positive side, Brian, I can imagine a situation where those individuals who aren't part of the institution, they've led me to a grittier life with more effort and so on like that. They didn't have the gilded part that you described earlier. They may have advantages both in the lived experience, and I wonder, do they come up with different or better business models because they have a different way of thinking? Do you find that?
That's a good question. I don't know that I've ever seen that lean too hard one way or the other. I think there are very creative humans in both of those categories who have an ability to just spot, alpha, an ability to spot any type of mismatch in a market that exists. And I think that is absolutely something that I spend time on, is looking for founders with unique business model ideas. People ask me what I invest in. I say I'm a fairly generalist software investor, but I spend a lot of time understanding how you sell your business. And founders who deeply understand, how to move a business from 10K ACVs to 75K ACVs, and how to expand from selling, 100% today and 140%, net revenue expansion a year later. Like, those motions are what I learned when I was a software investor at Goldman, are really what unlock a business that's moving from 10 million of ARR to 100 million of ARR. So I think that if you have some insight into why software is being sold incorrectly in the ecosystem or industry that you're going after, it can benefit you a great deal. And sometimes can mean that you didn't need $50 million of spend in order to get to the same place as the company that had that money. You could do it with $7 million or $10 million. So I don't know that I don't know that I would lean one way or the other, but I do love creative business models.
So that would make it sound like you don't have an algorithmic approach to screening potential entrepreneurs and potential businesses, not a checklist. It sounds like it's a little bit more of a feel, empathy.
I think it has to be at the stage that we invest at. Like I said, I spent 6.5 years at Goldman Sachs. I was a growth equity investor. We'd write $30 to $75 million checks in businesses doing north of $10 million of ARR. I could get in a data room without meeting a founder and know roughly whether or not this was the type of business we'd invest in. You have 5 years of cohort data. You have 75 reviews on the internet of how customers use the product and how it compares to the other 6 products that are out there. It's just such a different motion than investing at pre-seed and seed and frankly even Series A businesses. These days, you're spending so much time on sort of addressable market and product competitiveness and founder risk appetite and all the things that I think are a little bit harder to just put into a computer and have it tell you what to do. I even spent time looking at the syndicate around the business. What type of investors do you attract? What do they say about your potential? The ones who have been with you since the angel round, how do they like your communication style? Do you respond when they ask for things, or is it 2 weeks and you forget? All those things matter a lot when you're in the earliest years. And so I think you have to be careful putting too much of it into an algorithm.
So you started Collide Capital. That's what you mentioned at the beginning, collidecap.com. And you started, you've raised $66 million from what I've read in the reports, but you started at a low level. You called it Fund Zero, I think. It sounds like a bit of an experiment. Can you tell us that story?
Yeah, I can. You did your homework. Way to go. My partner and I got together in 2019. I was heading into Harvard Business School after my time at Goldman, and my partner was running a business. My partner, Aaron Samuels, is co-founder and COO of the largest black media company in the world. It's a company called Blavity. It powers north of 250 million views a month across its digital assets, and they built the largest black tech conference in the world, which is called Afrotech. And I felt like coming out of Goldman, I deeply knew I wanted to build a venture firm. But also through my work building Black VC, saw what it was like for Black emerging managers and female emerging managers and brown emerging managers, and knew that without some form of track record, it was going to be very difficult to raise capital, at least the amount of capital that we were trying to raise, which was $40 million. And so my partner and I got together and we built what we think is one of the most creative ways of breaking into building your own firm, which is we call it Fund Zero. We raised $1.4 million from 4 venture capital firms in the form of scout checks. And so Lightspeed Venture Partners, Canaan Partners, Pear VC, and a fund in Boston called Flybridge Capital.
What's a scout check, Brian?
Yeah, so a scout check is when a venture capital firm is looking to effectively build a farm network. So if you think about having access to a lot of companies in a very, very small way, but doing it across a large surface area. And so if you think about how many employees a venture capital firm has versus how deep and expansive their network is, the model and the rationale they built was that, hey, you've been at Meta for 7 years, and every now and then somebody leaves your team who's exceptional and says they're going to start a company. And so we're going to give you $250,000. And every time that happens, or every time you see an interesting business in and around your ecosystems, we want you to write a $25K check and keep an eye on that business, scout that business for us. And so that if it really gets off the ground, you bring it back to us, we'll incentivize you to bring it back to us. And then our firm will invest in that company. And if I do that, 5 to 10 times across a $250K allocation, the likelihood of one of those kind of being worth more than the venture firm than $250K is pretty high. And so most of those firms only like you to scout for them naturally. But we were very fortunate to build deep relationships with all 4 of those firms. And that allowed us to build effectively a pool of assets that in turn just became our Fund Zero. And so we made 35 investments across that vehicle. and learned the job. We learned how to write memos together. We learned how to argue about deals. We learned how to get onto cap tables. And it really formed our opinion of how to build the firm. And also, luckily for us, started forming relationships with LPs, because of the work we were doing to sort of generate the firm and build the concept of the firm. We spend time with LPs thinking about, what does portfolio construction look like? How should we think about building our brand? How do we think about building our team? And ultimately went out in January of 2022 to raise our formal Fund 1. Our target was $40 million. And we were, you mentioned it, we were very lucky to just have a lot of appetite for what we were building. And so we closed the fund at $66 million in August of 2022. The fund is anchored by the University of California Endowment System, a group called the UC Regents. Mm-hmm. And we've been investing out of that vehicle ever since. We've made 24 investments in that fund. So across the two vehicles, we've almost made 60 investments now. And so continuing to build the firm and the portfolio, but excited for what's to come.
So congratulations on that. That's fantastic. We're delighted to announce the Value Creators online course. For entrepreneurs in every kind of business, big, small, or medium, at every stage, in every industry, our course provides the foundations and principles on which to build success. Simple, clear purpose and principles give rise to creativity, innovation, and competitively superior business action. There are 11 foundational principles or mental models that together cohere into the value business model. Principles for value generation, principles for value operations, principles for value finance and accounting, and principles for value sustainability, as well as the new knowledge accumulation you'll need for continuous innovation. These principles are delivered by top business professors from top business schools: Mark Packard, Per Byland, Gordon Miller, David Rapp, and Bart Vanderhagen. You'll find video lessons from them, along with downloadable tools, processes, and other valuable content. Master these lessons, and you'll master the most important skill in business: value creation. Go to thevaluecreators.com and click the course link. Are you able to talk about any examples that Collide Capital Investment has unleashed an entrepreneur who might otherwise not have had access to that kind of investment and coaching and support and so on? Is there any stories you can tell?
Absolutely, man. There's a ton. I'll use one for international purposes because I think that's even harder as this business expands into the U.S. He's done an incredible job. So we have a founder in our portfolio named Myron. Myron is the founder and CEO of a business called One Car Now. And One Car Now is a rent-to-lease subscription business for Uber drivers in Mexico. And so what they do is, rather than you going to some sharky kind of rental service with high interest rates and, ridiculous paybacks and horrible, complications if you break the lease, they're building a rent-to-own process where for 3 years you drive one of their cars and they incentivize you through a pretty heavy discount at the end of those 3 years to get to own the car. And it's bringing drivers onto the Uber and DD platform that otherwise never would have been able to access it. And, the amount of money that you can make in Mexico as an Uber driver is pretty remarkable. A lot of people don't fully appreciate how many drivers there are in Mexico and how many different geos there are. And so incredible business. We met him probably at about $1 million, maybe $1.5 million of ARR. The business has 15x, 20x since then. And Myron didn't have a ton of experience understanding how to navigate investing. He just built a really nice business, and he had an incredible group of angels around him and just people who wanted to support him as a young founder. He's only 23 years old, maybe 22 when I met him. And slowly over the years have really worked hard with him on understanding the impact of storytelling and understanding sort of how to integrate not just the software and sort of capabilities of the business, but also the impact to the communities that he's serving. So I think he underestimated the value to investors of having impact that drives outside of just financial return. I think people, especially people who are building for underserved communities, oftentimes are shy about sharing that story. And I tell them, as long as the business is working as well, that's a cherry on top. You should look at that as an absolute benefit. And I think too many of them hide it because they're worried that they get, labeled as impact oriented. And if you can build a remarkable business and change the world at the same time, I can promise you there's a lot of people that have appetite for it. And so I helped him understand sort of how to reintroduce that part of the narrative, because it was on top of the incredible business he was building as opposed to it. It's little things like that. I sit on his board now. We just raised his Series A. And I took a board seat because I just want to continue to help him. And the business has just done an incredible job. He opened a $80 million line of credit that's helping him, as I said, expand into the US and continue to grow. And I'm really looking forward to the rest of his journey, because he's picked up a lot of that storytelling archetype across customers, across investors, and you see it starting to compound. And I'm happy to just play a small role in kind of helping him believe in that.
So it's a great story, and it takes us to that next level beyond the business, as you say. And you mentioned it in your materials for both Black VC and for Collide, which is community, raising the community, improving the community, strengthening the community. And I have a biased interest in this. I work for a group called Entrepreneur Zones, which is trying to do that for inner cities, distressed areas, give them that idea of entrepreneurship as the way up and the way out. It's really hard at the community level, but please talk about that. How do we get that culture in these depressed areas, I say, especially inner cities, but also some rural areas and things like that? How do you make the transfer from the great business to I'm raising the community and giving it a better entrepreneurial culture?
Yeah. I think you do it arm in arm. I think at the end of the day, building community is already hard in places that have the resources to do it, let alone the places that are struggling to find the resources to do it. And so the best examples I can think of entrepreneurship ecosystems outside of, New York, SF, LA, Boston, Chicago, are ones who were super hyper collaborative from day one. They found a way to say, they found a way to raise their hand. I would say that's one of the things, to ask for help. I think a lot of both founders and entrepreneurial ecosystems struggle to ask for help, or at least articulate that ask for help. And, I'll shout out the Tulsa, Oklahoma ecosystem. The Build in Tulsa team, and Techstars, and some of the work that's been done there by the Skoll Foundation, and they all sort of locked arms. They all sort of got together and said, the only way to change this is if we all bring our networks and ecosystems to it. And I think that if you go into ecosystem building with the idea that you're going to be the head of it, or that you're going to lead it, or that it just that it matters who leads it, you're going to get stuck. And I think instead, ensuring that you care more about the outcome in 10 years from now for the community than you do about what it does for your personal brand, that intention will help bring more people who are authentically trying to help you around it. Yeah.
I can see that. And that's great guidance. I wonder whether there's a level beneath that or prior to that, which is education. How do we get our young people to learn this entrepreneurial ethic? That it's not just about personal success, it's about helping others and the group rising. It's hard to teach it at schools in today's institutions. And some of us learn it at university, but it's not a universal kind of way of thinking for young people, I don't think. You may disagree, but is education a big part of this?
I think education is a part of it. I think exposure is a bigger part. I think if I can get 10 people to go to the boot camp, that can have a bigger impact than telling 100 people that there are a boot camp. I think that's where I'm falling on that, is that it's just really hard to get, it's really hard to get critical mass on people caring about the things that you're doing, you know? And so instead I think this is true on fundraising as well. You know, like I think just instead of emailing 100 people that invest in venture capital, I'd rather email 10 people twice as intentionally with an email that's thoughtful, who I know focus on emerging managers, as opposed to just focus on venture capital, you know? And I just feel the same way about this kind of stuff. You have to have at least demonstrated some curiosity in entrepreneurship in order for you to really kind of show up to those ecosystems and actually derive value and bring value to them, you know? And I think I look at when I was in school versus today. I mean, there was no job coming out of college to get into venture capital when I was coming out of Stanford. It was not even an idea. And today there's 150 jobs on the job board of analyst roles or joining platform teams, or the industry has just unlocked completely. So if you're telling me, you know, is it education's fault that less people are getting into it? I'd say no. I think there's other road barriers. You know, I think there's other blockers. And if I had to spend 10 years fixing the blockers, I'm not sure I'd spend all of my time trying to increase education as much as I was trying to increase access.
Yeah. It's a good analysis. So I translate that as experiential learning, which is just do it. Learn by doing. And
fellowship. I would say fellowship is one of my favorite new words. It's sometime, you know, 30 years ago, rich white people decided that fellow meant more than intern. And if you were a fellow, you were selected out of a high pool of, you know, XYZ candidates. But an intern, anyone could be an intern. And so we've built a lot of fellowships in my time with organizations because I believe in how they unlock future opportunities for students. So it's one of my little wrinkles on things where it's like, I guarantee you the fellow and the intern would be doing the exact same thing inside of this organization. But boy, let me tell you, the fellow is just going to get an awesome job after this. And the intern is just, you know, so it's little things like that. Again, back to your question around how we kind of help unlock these students. Sometimes it's not even trying to educate them on how to do it. It's just doing it for them.
Yeah. And languaging is important too. I always
Sadly, exactly.
So I like that. You make up your own language, which is fellowship.
We make up our own language. We say we try to kick down the back door. You know, we try to. We can't walk. It's been proven now that it's going to be hard to walk more people through the front door, and so instead we're just trying to kick down the back door. You know, and you never know who can scramble in if you kick down the back door. So we try to unlock founders and get them access, maybe in ways that aren't as traditional as people would think.
So that sounds very encouraging about the progress has been made since you came out of school and couldn't find a door with VC on it. Take us a little bit into the near future. Things getting better. We're getting better at getting more people access to investing, and we're breaking down the barriers. Do you feel good progress?
Man, I'm going to give you a pretty gray answer on that, which is we've made a ton of progress and we've also made no progress at all. I mean, there's absolutely more check writers that look like me, you know, people who have access to capital and are giving founders a real chance to go and build a business. And I get really excited about that. The number of Black-led, female-led, brown-led GPs has absolutely increased. Certainly to no abundance. I think we could use 5x as many of them, but the venture capital ecosystem is very competitive, and there's just not room for 5x as many of them. Frankly, there's not room for as many as there are right now, and I think the market is starting to tell us that. Yeah. But I think the right ones are staying, and the right ones are getting access. And by right ones, I mean ones who have a differentiated opinion on where the world's going and are helpful to founders, and that founders are raising their hands saying that these guys deserve to exist. And so we try to do both of those things. On the flip side, there's just a clear flight to quality right now. And LPs have just, I think, felt pretty burned by the VC ecosystem over the last 10 years. And it was just dollars in, and there was no liquidity. And I think they were okay with that until 2020. and then they got distracted accidentally by this thing called COVID and then put more money into it. And now they're all kind of clearing their eyes from that and saying, wait a minute, we still feel the exact same we felt in 2020, but now we have 2x as much in it. And so most institutional LPs are rebalancing right now. And so on the venture side, not only are they trying to cut, but it's hard for their existing managers to find re-ups. So very rarely are they adding net new relationships. And so you think about how many of those underrepresented managers are net new relationships, and it's 85% of that ecosystem. You know, most of them are on fund 1, fund 2, handful that have made it to fund 3, but there's not a bunch of fund 7s and fund 9s out there.
Yeah.
And that's where most LPs have run. And so it's not great for the emerging manager ecosystem at large. So it's a little bit of both. Sorry to give you a gray answer there.
No, that's fascinating. Actually, I try to think about the future of capital in that sense, Brian. I'm thinking at a more of a macro level, but the bigger the financial sector gets, the tighter the productive sector is squeezed. I mean, there's a lot of data on that. You know, the money goes into trading and exchanging certificates more than it goes into investing.
Sure.
And we think about fintech and we think about blockchain, we think about distributed financing, and can finance become less institutionalized? It's just an app on my iPhone where I've got some investors on one side and some entrepreneurs on the other, and the access is free. I got to prove my case, obviously, but the barriers come down. It becomes deinstitutionalized on the finance side. Is that possible?
If it's possible, I don't know how to do it. I think, and I think it would have been done by now. I think access to capital will always be restricted. It will always be regulated. There will never not be a 1% that owns way more than the bottom 60%. Sadly, I think we're talking about like fundamental changes in democracy in order for us to get to that type of world. I think you could even look at the lack of deregulation or sort of blockchain adoption that's happened across the enterprise as an example of that. I think there's absolutely strong examples that exist for why blockchain technology should be instituted in financial systems and markets across the world. But it hasn't happened. And it hasn't happened because those systems are run by vast regulations and vast groups of people who already know how to make money and are making money. And the likelihood that they make money faster might not be as lucrative as the likelihood that they lose money very quickly if things don't go right. And so I think adoption of those types of technologies has just taken a really long time and will continue to take a really long time. And so I'm not sure that some parity world exists. I think what changes is that the businesses that are being built by these founders who traditionally didn't have access start to do really well.
Yeah.
And the institutions that typically have not looked at those businesses because they haven't seen great examples, to my point around pattern recognition, are able to, without squinting, kind of look around at ways to make money on businesses that are run by groups that they traditionally didn't have access to. And they will then divert their dollars to those ecosystems as a point of diversification, as opposed to anything else. And that is my North Star. That's what I wake up looking to do, is give a founder, $2 million so that someday he or she can raise $200 million from an asset manager, because ultimately at that point, we will have proven that those organizations should spend more time looking at these types of businesses.
Okay, so I buy that. We're not going to change the institutions. We're going to change the ability of the entrepreneurs to succeed, and you're coaching them and investing in them. Technology can help them if they can have access to it. So I'll paint the extreme picture. I had David Kramer from Cooperative Computing on the podcast, and he's talking about the future of AI. And he painted this idea of the AI as your entrepreneur's operating system. I develop a business concept, a business model, to some degree, and the AI does all the operations, including setting up the supply chain, doing the financing. It'll go out and raise you $3 million because it's an AI. It can do that. That's a bit extreme, obviously, although it's an interesting thought experiment. But can we get the technological support to to your group of others who don't have access to the institutions, but they may have access to the technology?
Yeah. Technology has absolutely helped them. I mean, I think you know, at the earliest of days, technology has demonstrated an ability to what I'll call improve democratization. Find ways to give more people access to things that traditionally they did not have access to. We can use the internet, we can use YouTube, we can use, whatever you want to use that has just given people exposure to things. I mean, I've talked to my parents about this. Their grandparents, the only way they knew what was going on outside of their city in Pittsburgh was the newspaper. And so imagine effectively having 4 websites that told you everything that you needed to know, plus a TV. I mean, today if you wanted to learn about, Taekwondo in the hills of, some foreign country, I mean, you could learn who the number 1, 2, 3 people are, and you could probably find their email address. And so I think the technology will continue to do that. I think the issue, or sort of my unfortunate cynical take on David's potential world, is just that the AI still needs to be coached, and you still have to tell it what to go do, and you still have to know what a supply chain is to tell it to go build a supply chain. And all of the components actually, they really just take experience, and ultimately the most successful founders are those who either have that experience or they know already intuitively how to surround the company with that experience. Mm-hmm. And so for people who don't have that experience or don't have those people around them with the experience, I think it would be hard to use AI to inform you on exactly how to scale a business successfully. And what you might end up with instead is just an agency or a services business where people are coming in and telling you how to tell the AI what to tell you. And that world seems far away to me.
Yeah.
But I like to think that could happen, because boy, oh boy, it would start helping a lot of the people that I, want to see succeed, for sure.
Well, a different way of saying that maybe is that you can build bigger businesses with fewer resources. Mark Andreessen, you mentioned A16Z. He talks about the one-person billion-dollar company.
Yeah, exactly.
And again, he's being extreme, but he's pointing out that there are businesses now that are increasing their revenue while reducing their bureaucracy and their overhead, and they're automating processes and so on like that. And it seems that can be done out of the box. You can start that in your first business, right? Do you agree with that? I do agree with that.
Again, with the caveat that the person who builds that business, I think is going to come from such a sophisticated lens. It won't be someone who accidentally came upon ChatGPT and just whoops, happened to build $100 million run rate business. But I do love the idea that technology is now at a place where you could send, agentic workers out building script in the corner, and those projects could go live, within 2 to 3 weeks. And all of a sudden you have an army of, very capable, high functioning agents working for you. That absolutely is starting to happen today. Again, it's not being adopted across the enterprise the way that people believe, but the way that it's being used in hobby form today is how it will be used in enterprise form in 5 years from now.
Yeah. And let's accelerate that. We just got a few more minutes, Brian. You also associated with the Takeoff Institute, and the banner that I read is building the Black leaders of tomorrow, which sounds like it's beyond entrepreneurship and beyond community. Tell us about the Takeoff Institute.
Yeah, thanks for shouting that out. So I built the Takeoff Institute when I was at Harvard Business School, and we spent a little bit of time actually earlier talking about fellowship, and that's somewhere where some of this origin story came from. So I was at school, and when I was at Goldman, I was lucky enough to help lead diversity recruiting for Stanford for a few years while I was there, and so learned a lot about of the 1,000, 1,500 applications that come in, who are the 10 that get a slot, and sometimes it wasn't as easy as you'd think. It wasn't always these schools or this background or XYZ. Oftentimes it was just sort of what I think of as I sort of call like resume productivity. Which is that they found a way through college to add a bunch of stuff to their resume. those were often the people who made it through. And so I spent some time when I was at HBS thinking about, what can I do for undergrads, particularly Black undergrads who I thought needed support breaking into some of these higher functioning roles. And I developed a Takeoff Institute summer fellowship. And in that 8 weeks, we do a lot of the work of getting you prepared for your young professional journey and thinking through, what do I need to know when I get to the desk? So we built a partnership with Wall Street Prep. Our students have to go through a PowerPoint and an Excel tutorial, because those are two of the skills that I think are most valuable when you're on the desk. We teach them cold emailing. We teach them the idea of what we call managing up. So how do you actually deal with a bad boss? We teach them a whole host of things. We bring in speakers. We give them access to Black executives, so doctors, consultants, bankers, founders, just help them. We call it, you can't be what you can't see. We put them in front of people who look like them, who are out doing those jobs. Because I remember when I applied to Goldman, I had what's called a super day. If people are familiar with super days, I probably did 15 interviews from 9 a.m. to 4 p.m.
Wow. And
didn't see a single Black person. And then I worked there for 6.5 years, and I realized there's incredible Black people at this firm. There's MDs. There's people in the partnership who are Black, but you're not going to meet them in your interview process. And so we bring these people in so students can have that confidence of knowing, okay, I might not see this person in my interview, but I know they work here. I know there's a path for me to do this someday. So, very proud of the work we've done. We've graduated over 250 fellows in the 5 years we've been running it. We take about 50 every summer. And, if there's any Black undergraduate students listening, please sign up for the wait list for next summer. Thanks for shouting that out.
Good. Well, Brian, let's wrap up there for time. You've done so much, and you've achieved so much, and you've helped so many people and been successful in your business at the same time. So you're a great example and a great leader, and we really appreciate the time that you spent with us. Thank you.
Thank you, Hunter. I appreciate that. And like I said, for anyone that's listening, Brian@collidecap.com. I can't answer every email, but if you send a thoughtful one, you never know. I might get back to you. So good luck with whatever you're building, and I hope this was helpful.
Good. Thank you very much, Brian.
Thanks.
This has been another episode of the Value Creators Podcast. Thanks for listening. You can visit thevaluecreators.com for links and resources related to this episode, and check out hunterhastings.com for more content on entrepreneurial business management based on value creation principles.